Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Stride Inc. quarterly report. Stride Inc. offers a wide range of businesses and services that cater to various educational needs. The company's products and services include online curriculum and software systems, educational services for students from kindergarten through 12th grade, integrated packages for virtual or blended public schools, learning software and support services for schools and school districts, individual online courses, and supplemental educational products, career learning programs focused on developing skills in industries such as IT, healthcare, and business, tuition-based private schools, post-secondary career learning programs under Galvanize, Tech Elevator, and MedCerts brand staffing and talent development services for employers. Stride Inc.'s stock price plummets due to cautious guidance and technical issues in the past year. Stride Inc.'s stock price has dropped significantly by over 24.9%. The main reasons for this decline include conservative FY 2026 guidance that fell short of Wall Street's expectations, technical platform implementation issues that led to a poor customer experience and loss of enrollments, and ongoing shareholder investigations and prior fraud allegations. The company's cautious guidance, projecting only 5% full-year growth, was met with disappointment from investors. Additionally, the technical platform implementation issues resulted in higher withdrawal rates and lower student conversion rates, causing an estimated loss of 10,000 to 15,000 enrollments. These factors combined have led to a substantial decline in Stride's stock price, with shares plummeting approximately 35% following the Cone FY 2026 earnings report. The primary drivers of revenue growth or decline are multifaceted, but can be summarized into several key factors. Revenue growth is primarily driven by the expansion of general education and career learning products and services, as well as licensing agreements with schools and individuals for curriculum on a subscription or course-by-course basis. The acquisition of Galvanize, Tech Elevator, and MedCerts in 2020 also contributed significantly to career learning revenue growth. In contrast, revenue decline is largely attributed to decreased accounts receivable and inventories. However, it's worth noting that these factors are not necessarily indicative of a long-term trend, but rather a snapshot of the company's financial situation at a particular point in time. The mix of enrollments across grades and states, as well as state or district per student funding levels, also play a significant role in driving revenue growth. Additionally, attendance requirements can impact enrollment numbers and subsequently affect revenue. Overall, these factors demonstrate that revenue growth or decline is influenced by a combination of internal and external drivers. Net income and profit margins. A shift in favor of the financial performance of the company has undergone significant changes between 2024 and 2025. Notably, net income experienced a substantial increase of plus 69%, rising from $40,882,000 to $68,800,000. This growth can be attributed to various factors, including revenue expansion. Profit margins also saw an improvement, with gross margin increasing by $26,270,000. Although profit margins are not explicitly stated for 2025, the 12.7% revenue growth implies a higher margin. Furthermore, net income as a percentage of revenues rose from 7.4% to 11.1%, indicating a significant increase in profitability. These changes suggest that the company's financial performance has improved significantly, driven by increased revenue and efficiency gains. The plus 69% rise in net income is particularly noteworthy, underscoring the company's ability to generate more value for its stakeholders. The company's financial performance indicates a strong ability to generate cash from its core operations. With positive operating cash flow, the company is able to cover its expenses and invest in growth initiatives without relying on external financing. The significant net working capital of $1,406.5 million and substantial cash reserves of $518.4 million further demonstrate the company's financial stability and flexibility. The company's debt level has not changed significantly, remaining relatively constant at $416,751 million for both September 30, 2025 and June 30, 2025. However, there was a minor increase in finance lease liability from $86.9 million to $125 million. In contrast, the company's interest expenses have increased substantially, with a 30.8% rise from $2.4 million in 2024 to $3.1 million in 2025. This significant increase in interest expenses is a notable change for the company. Management's outlook on company strategy. The company is focused on innovation and expansion of its personalized learning model through investments in curriculum development and partnerships. It aims to remain at the forefront of effective educational techniques by expanding its school-as-a-service offering. The company has seen a 12.7% year-over-year revenue increase due to growth in enrollments and changes in school mix. Management is confident that funds generated from operations and net working capital will be sufficient to finance ongoing operations. However, they are also exploring acquisitions, strategic investments, and joint ventures related to the business. Additionally, they are aware of the potential impact of inflation on operating results and may undertake hedging strategies to minimize currency fluctuations. The company's financial summary reveals that it does not pay dividends to employees with unvested stock awards. Additionally, there is no explicit mention or indication of share buybacks in the provided information. That concludes the financial summary for Stride Inc. Feel free to comment below, and I will be happy to answer them when possible.